how do we play the game in a world where DCFs don't matter, fundamentals don't matter, and it feels like everything is about the beauty contest and trying to figure out who the judge in this case, policymakers, central banks, who do they find, sort of prettiest in that beauty contest? How do you invest in a world where it's more about evaluating reactions than actually intrinsic value?
To many investors, the market feels crazier than ever. With sky-high valuations, central bank intervention no longer being the exception but the rule, and the increased dominance of passive investing, it feels like the rules of the game have changed with no obvious end in sight. But whether you're an individual investor or an advisor managing money for clients, you simply can't opt out and get left behind. That means adapting with strategies specially designed for this new world of investing.
So tell me about the transition from hedge fund world to the dark side. Welcome to the ETF world.
Thank you, Paul. I don't consider it the dark side, but unless you're thinking, Superman dark side sort of thing. But this is my second time in the retail space. I worked for Royce & Associates offering mutual funds for an extended period of time. And I'm ecstatic to be in a position to do this because the availability of resources and the change in the availability of resources to change portfolio construction, particularly following the dynamics of the derivative rule that came out last year, it actually gives retail the ability to participate in the strategies that I've only been able to offer in the institutional space. And the need has never been greater. You hear me talk about passive and my frustration with it, et cetera. And one of the challenges and one of the ways I think my views differ from most is that there's no sign it's stopping. Part of the challenge is that you have to participate. You
don't hate passive.
Well, I hate elements of passive, right? I hate what it's doing to markets in a lot of ways, but it's just really frustrating because most people who rationally look at these markets and say, this is crazy, the reaction function to that is to then step away, right? And overhedge their portfolios, fail to participate, et cetera. Managers complain about it all the time, and the world's smallest violin gets broken out for the hedge fund manager saying, it's just so hard, right? But the reality is that group is kind of well heard from. There's another group that faces career risk and challenges, which is the IRA community, right? Because the IRAs, they've been doing this as long as you and I have. They understand when things feel crazy. They try to protect their clients' portfolios, and then they expose themselves to adverse outcomes in terms of a client coming in and saying, you didn't keep up with the S&P. And the answer to that, of course, is, fraction of your portfolio is invested in bonds for protection, or, we had to do X, Y, and Z. You're 75 years old, and we don't want you to be in these things. How do you see that problem? How do you think about the dynamic of how you can help an RIA or a professional in the industry that's struggling with communication with clients or explaining to them what's going on? And I go even a step further and just say, when you think about core products that simplify, things like the convexity ETFs, et cetera, are they tactical or are they strategic products?
That's a great question, and it's an important one. You're basically asking about career risk, right?
Yeah.
And when does it pay to be a hero, and when is it really a one-sided bet? More to lose than gain. And a big reason why we designed our core suite to be strategic exposures and be essentially beta 1 products is because of the fact that any RIA that deviates from market exposures is opening him or herself to criticism, or if he significantly underperform, ultimately getting fired, right? So career risk. And so how do you address that? Well, first, deliver sort of the exposure that people want. So if we have a beta 1 product, make sure we're fairly tracking that beta, S&P 500 or NASDAQ 100, whatever the preferred beta is. And then separately, create the asymmetric payoff where they can be heroes if they protect against the downside or significantly add to returns, but in a way that's never having to time that. So the timing luck, timing skill, timing signal, remove as much of that as possible and try to create asymmetric payoffs in probably, relatively low probability outcomes. But when these scenarios happen, the payoff is significant. And frankly, on the downside, when they happen, it is when you, as an advisor, can become a hero. And that's when you could grab market share from peers because you've provided the toughest thing, which is track the upside when everything else is going up, but most importantly, protect the downside when, frankly, most peers have not protected the downside, right? Or have an inability to protect the downside. And that sort of combination is the unique value proposition of having these deep out of the money hedges inside of our portfolios, the power of convexity, which you know so well, the power of being long vol when it's priced correctly.
For me, that's part of what I'm incredibly excited about, right? Because I truly believe that the derivatives markets have been affected by market structure, right? That we're looking at a situation in which you can be simultaneously a value investor and be in the derivative space, which, you know, theoretically you're not supposed to. They're supposed to have fair pricing. We've spent a lot of time in the past week talking about the dynamics of unfair pricing that's emerging. My proverbial, you know, the roulette wheel has become imbalanced, right?
Yeah.
And when you have that type of characteristic, I think there's the opportunity to add quote unquote alpha to a portfolio and help them, but that upside is the most painful part for most people right now, where they're just looking at things and saying, this is crazy, I have to protect my clients' portfolios. Yeah. And they're so frustrated because they know they're doing the right thing. They know what's going on, and they just can't put their handle on quite what's happening. It weakens the market environment broadly. And I agree with you, that downside protection is where, you know, the RA shows up as the hero. But to stay in the game, you got to be able to keep up, right? And that's where the convexity components really can play into a portfolio construction. Adding that juice without, you know, as I refer to it, the non-recourse leverage to the portfolio that allows you to stay in the game even as you feel protected.
Yeah. You do right by the client, but also right for the business, right? And that's the perfect combination.
Yeah, totally agree.
And we could scream and complain. It doesn't matter. We both have CFAs. We both have valuation views of the world, but it is what it is. The world is what it is. You could adjust to the data and facts or stay stubborn in your previous view, right?
Absolutely correct. I mean, you know, we all have a tremendous amount of respect for people who have applied, you know, significant empirical research and said, you know, the valuations that we currently have offer X sort of return over a 10-year time horizon. One, it's really hard to know because the data sets that we have in terms of markets are fantastically small in the greater scheme of things, right? I mean, realistically, we have basically 100 years of data, right? We're actually approaching 100 years to the 1927, 1928 data sets that begin the Fama French sort of data series. That's a really short period of time in the you know, the span of human history, and most of that has been characterized by, you know, a particular form of market structure.
And it hasn't been homogenous. You have sort of the Great Depression mixed in with the last, I would say, 10, 12 years.
Yep.
Feels like just completely out of sample, right? Completely bizarre world, negative interest rates, everything's just backwards.
Well, I mean, that's one of the great ironies, right? Is that we look at the equity markets and we kind of broadly say, you know, well, you know, things are going to remain the same, and then we simultaneously say interest rates at 5,000-year lows, right?
Yeah.
And, you know, this is unprecedented. It's never happened. We've never had negative interest rates, et cetera. The idea that those two statements can exist at the exact same time, to me, feels a little false. And so, like, you can get as upset as you want about the situation as it exists. There's only two things you can do. You can advocate for awareness and change, or you can continue to play the game, and you actually probably have to do both.
And so let's talk a little bit about playing the game. How do we play the game in a world where DCFs don't matter, fundamentals don't matter, and it feels like everything is about the beauty contest and trying to figure out who the judge in this case, policymakers, central banks, who do they find, you know, sort of prettiest in that beauty contest? How do you invest in a world where it's more about evaluating reactions than actually intrinsic value?
Well, it's always been about the beauty contest, right? I mean, it was the Keynesian beauty contest that refers back to the 1930s, right? So when you think about that sort of dynamic, the fact that you can kind of comfortably say, yeah, that makes sense.
Yep.
The weird question becomes, like, who's the marginal player? Who's the person who you actually need to impress with your beauty, or just to select on the basis of that matters, right? And to the extent there's any contribution that I brought in, it's identifying that, look, the marginal player is the passive player now, right? The incremental capital that's coming into the market is the passive player. And so what are the rules by which they select beauty?
Is there a rule? It just feels like you talked about that topic, inflows, outflows.
Yeah.
Is there judgment there, or is it just people are investing their 401k and it's just a systematic inflow until it isn't? How do you time that?
Yeah, no, so the answer to that, of course, is yes, right? I mean, it is a systematic inflow in terms of the passive dynamics, and the system has become increasingly on autopilot. Every 2 weeks, a portion of your paycheck is withheld and used to buy the market. Should it buy the market? Is it appropriately priced? Are the stocks that it's buying, well researched, and are their fundamentals improving, et cetera? Nowhere in the model is that considered. It's presumed that everybody else is doing the work, right? That's the core of the efficient market hypothesis and the observations of Bill Sharp in terms of the creation of passive type portfolios. The unfortunate reality is they can't be passive. You can't buy into a system. You can't sell out of a system and be a passive participant, right? The minute you enter into a transaction and decide to join a system, you become an active player. You're making a separate decision in terms of how do you apply that. And again, the rules there are actually pretty straightforward. How do you choose to buy? What do you choose to buy? Well, you buy what's in the index, and you buy it in proportion to its existing market cap, or more accurately, float-weighted market cap. So the rules are a little different on the bond side, but similar, right? Which is actually surprising. And so you end up in this situation where the rules of the Keynesian beauty contest are actually in many ways easier than they would have been 100 years ago or 90 years ago.
How is it easier?
Well, because the dominant players' strategies are exposed for all of us to see, right? So when Vanguard goes to buy in a target date form, and when you think about incremental money coming into the market, again, the majority of the incremental money that's coming in is going to come in through a 401k. It's going to be a 25-year-old who just got a job, and they start contributing to their 401k with their employer match. They buy into a Vanguard target date fund that's going to allocate them 95% to equities, 65% of which is going to be domestic equities, 35% of which is going to be international equities in terms of that 95% allocation. And what you're seeing here are all the rules that are being set in place, right? Within those domestic allocations, what are you selecting from? Well, you're selecting from the Vanguard Total Market Index, right? All of this is pre-programmed. One of the interesting experiences that we just went through in this last year is the performance of tips, right? And we've seen this in terms of things like inflation break-evens. Certainly the Fed's influence played a role, but another role that was played was the fact that in 2003, when those target date funds were programmed and set up, the decision was made that the 2035 funds, which kind of are the largest allocation of capital, starting in 2020, would begin buying tips. Right, so one of the largest tip buy programs in history happened in this past year, had nothing to do with the pandemic, it had everything to do with a decision that was made back in 2003.
So I love how deep and how sort of thorough you could get to sort of deriving a justification for buying something, right? But how is that very different from, I would say, 90% of the market that just says buy the dip?
Yeah.
It feels like in today's world, buy the dip is as good of an algorithm as watching flows and Vanguard and target date funds. It's a very simple rule, buy the dip. What's wrong with that approach? And are we going to see the end of that in our lifetime?
I think we'll definitely see the end of that in our lifetime. But part of the reason why you're doing that is because you're actually playing the Keynesian beauty contest. By choosing to buy the dip, you're actually saying, what are the rules of Vanguard? Right? Well, when equities fall in a balanced fund, Vanguard needs to buy more, right? Because they've now become a smaller portion of the portfolio than the target size. So they're buying the dip. All you're doing is trying to do it before they do it, right? And so the faster you react, the faster...
So what breaks that cycle, right? I mean, March, we were staring essentially, it felt like financial ruin, if not sort of much, much worse, right? And it was just the fastest drawdown, but it was also such a fast and violent reversal and recovery. And so it's only become more ingrained to buy the dip and just get ahead of everyone, whether it's the Fed or large institutions or other retail investors. What breaks? Why does that break? Why does that reverse?
It becomes self-reinforcing, and in the Hyman-Minsky type framework, right? That reinforcement ultimately sets up the break, right? Because if everybody decides to buy the dip, you don't get any dips, and perversely, you would actually create the conditions under which Vanguard could then show up and sell, right? Because now equities have suddenly appreciated, and we saw elements of this. The other thing that is interesting is that we've now seen a couple of times where it felt like the world was going to end, right? So, the dynamics of Volmageddon in February 2018, and then the fourth quarter of 2018 again. And then we see the coronavirus dynamics, right? A good friend of mine, Vincent Deluard of StoneX, right, their chief strategist, has actually written a paper and observed that the last several market bottoms, have occurred roughly around option expiry in the quarter of each year, right? So we had a bottom on March 23rd, right? The option expiry, that's a Monday, right? The option expiry was the Friday before. In 2018, the initial collapse in Volmageddon, followed by the low that was achieved in March, also occurred on the option expiries as you approach the end of the quarter. In December, same thing, right? December 23rd low. So you're entering into these frameworks where, again, it's actually crazily enough mathematically programmed in what's happening. The hedging requirements in the market as those options expire are reduced. The market makers don't have to engage in the same quantity of hedging. And simultaneously, those balanced funds are kind of forced into a structural change of their behavior as you approach the end of a quarter, right? Because they have to show a balance that matches their programmatic framework as you get to the end of that quarter. So like all these things are reinforcing, and if you take the wrong message from it, you're going to become blind to where it breaks down.
So if they're all reinforcing, it just seems like you have multiple different reasons to buy the dip so far, right? Because you have natural sort of mean reversion. Anytime you have significant outperformance, you have rebalancing that force it at least a little bit down. If you have deep drawdowns, you have the Fed reaction function, these natural buyers who are going to buy the depreciated asset, or hedgers who no longer have to hedge.
Right.
If those are all self-reinforcing, where does that break? It just feels like three different reasons to buy the dip.
Well, I mean, now we know why buy the dip is such a good strategy, right? And I, the problem is, like, now I brought you over to my dark side, right? Because part of the way most people would approach this is they would say, well, stocks began going up, and therefore that indicated that the collective decision from the crowd was the economy was going to improve. That's the expectations channel. That's kind of how the market tends to think about it. What is the market pricing in? We've had this entire conversation to this point where we've identified all the reasons why the market could bounce and buy the dip becomes a good strategy. And not once have we talked about earnings or dividend yield or discounted cash flows or anything else.
Well, look, if buy the dip is a great strategy, why hasn't it been the perfect strategy for all time? I think our friend, again, Chris Cole, talks about periods where buying the dip is a path to ruin, basically, right? What's changed between those two periods, and will it ever revert back to a place where buy the dip is the absolute wrong strategy?
Well, the quick answer is there's no way to know, right? Because if I look at what happens in the future, it's always unknowable. We know that it rhymes in some respect because people have repeatable patterns. But we don't have the exact same market that we had then, right? We have a baby boom generation that has accumulated assets that prior generations couldn't have imagined accumulating, right? And a huge portion of that has been a function of a dramatic increase in valuation. The S&P has gone from 4 times earnings in 1982 when the baby boomers first started investing to today it's north of 30 times earnings, right? And even higher on a normalized basis. You really have to kind of look at it and say, what could cause this to reverse? And I would argue the simple answer is that it has the seeds of its own destruction in there, right?
So it's almost a probabilistic view, right? Instead of saying you could call the direction, the market has created more fragility, and so maybe that's the right way to turn this view around and stop worrying so much about is it fundamentally overpriced, cheap, whatever, where is it headed. Let's just figure out distributions are wider now. The potential outcomes have gotten wider, and the violence of recovery in either direction has also increased. So that creates at least a probabilistic opportunity to create portfolios that take advantage of these odd sort of one-sided, skew, right? And sort of equally a recovery or mean reversion. How do you think about that? How would you build a portfolio that takes advantage of that kind of unknowable uncertainty?
You nailed it when you said the distribution is getting wider. That's what happens when fragility is increased, right? If you think about glass, right? Glass is very fragile. By definition, it's actually quite rigid and quite strong, but it also could shatter. And so this is the characteristic that we're broadly seeing in the markets. We're seeing an increased propensity of crashes and severity of crashes. And you can see this very mechanically if you look at the market since 2000, then 2007, and then the dynamics of the coronavirus crash, the Volmageddon event, which is something we'd never seen before, right? So you have this type of fragility that's all manifested itself in the last 20 years. That characteristic is embedded now in the distribution and can be explained when you have a rising fraction of purchases and ownership by effectively a mindless Borg.
So let's talk about that fragility. What data or what thing can we point to that reflects that beyond just seeing sort of the oscillation, which is one of the points?
Right.
What
So
else?
that's manifesting itself in the price behavior. You can measure that in a couple of different ways. When you talk about that distribution, you can actually empirically look at it, and what you'll find is that the propensity to crash, what's referred to as negative skew, right? So a market that will go down very, very quickly to a depth that makes no sense in the context of average day-to-day movements, that has risen dramatically. And that's actually been a pattern that, again, matches the penetration and growth of passive. Starting in roughly 1974, the market began to take on negative skew characteristics.
What's interesting, though, and I'll counter that, not debating it, but countering it, is also skew on the upside in single name, right? You've seen much more these sort of 30, 40, 50% moves in single names in a very short period of time.
30, 40, 100 times
100%,
moves, right? I mean,
yeah.
100 times, not percent.
100 times on these,
on
some
the
of
GME,
especially,
some of these things, yeah.
So that should never happen, but you're seeing it frequently now, and I think fragility works in either direction.
It absolutely does, and again, it goes back to this dynamic of that's what fragility means, right? Or the language that I use all the time to describe it is what I call inelasticity. So in economics terms, inelasticity is where the price moves dramatically because supply can't change or demand is not going to change, right? So one of the two factors in terms of the supply demand curve is very vertical, right? And so can't change, and therefore prices move dramatically in response to a change in either supply or demand, right?
So if there is this fragility and one believes that, how does one take advantage? What's underpriced right now?
So the irony is, if that's the case, then you got to introduce nonlinear services because that is a convex shape, right? If you think about that, the extreme move on the left and the extreme move on the right, you need to figure out how do you actually construct a portfolio to take advantage of that. And that's where it comes back into my world of derivatives. And again, the excitement that I have around the derivative rule that now allows you to incorporate this stuff into ETFs. And so when you think about a portfolio that owns the underlying index and then owns a proportion of puts against it, intelligently thinking about that distribution and understanding how that's changed allows you to identify the parts of the distribution that are improperly priced. In this case, the propensity to crash has risen, right? The propensity to have these extreme downward movements and these extreme increases in volatility, extreme correlation events has risen because people are increasingly transacting in the S&P 500 as compared to the stocks in the S&P 500.
But it doesn't allow sort of a prediction when it's going to happen, right?
No
But
idea.
the probabilities have gone up. So it requires portfolio construction that allows for probabilities but doesn't require timing, skill, or luck, right?
There's two aspects to how an option can be mispriced. An option can be mispriced in the context of an implied versus realized volatility. And again, anytime we're talking about derivatives, we're really talking about these options and these types of instruments that have a volatility component to them. So they can be mispriced in the way that most people think about it, which is the implied versus realized volatility. There was a forecast for volatility in the market. Did the market exceed that or fail to meet that? But there's a second component, which is effectively the path dependency in terms of the underlying price movement, right? And that's where the crashes become interesting and also the melt-ups become really interesting. And so the recovery off the COVID lows, that is unprecedented. We've never seen anything like this recovery, right? Particularly not from relatively high valuations and in the presence of continued high unemployment and everything else. Can we explain that? Can we explain the movements of the GameStops, et cetera, of the world? Well, the quick answer is yes, because what we're aware of is that there are players who are increasingly dominant in the game that don't consider any of these factors, right? They have the simplest rules. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. If you didn't do either of those, then I'm just going to hold. And nobody can convince me to do anything else because that's what my programming says.
Certainly trying to get alpha out of buying cheap options is one thing. That's hard and requires a lot of timing, but a portfolio construction that anticipates drawdowns and the ability to protect and hedge against that, the portfolio itself could earn outperformance even if your individual option or hedges aren't necessarily by itself cheap or underpriced, right?
Well, this is the classic 1 + 1 = 3 sort of stuff, right? Our partner David Burns has actually done some really, really interesting stuff on this in terms of the portfolio dynamics, changing the payoff structure, the moments as he uses the language in the portfolio, can have a really, really big impact. Losing less in a downturn means that you need to gain less to get back to even. And if you're able to keep pace or even outpace by introducing an element of convexity to the top side, if you continually lose less and make a little bit more, and then continually lose less and make a little bit more, you're going to end up with a portfolio that outperforms dramatically.
In the last 40 years, that's been the role that treasuries and fixed income has played.
Absolutely.
And it feels, again, not news for anybody, it feels like fixed income is no longer that reliable portfolio tool or sort of beneficiary of these rebalancing mechanisms. So are options a viable alternative? How else would you sort of build that inside of portfolios? Where else do you get this sort of rebalancing advantage?
Well, when you hit on the 60-40 portfolio and the bond dynamic, right? That's changed over time. And so, not to be pedantic on it, but if you go back and you look at the world pre-1998, bonds and equities tended to move together. Interest rates would go up, that would cause equities to go down. And so interest rates going up means bond prices are falling, right? That shifted in 1998 on a permanent and sustained basis as the Fed began reacting to financial events by cutting interest rates, trying to protect that portfolio. That Fed reaction function actually introduced a derivative into the bond structure, right? It had the potential to protect your portfolio. That, I would argue, has been a primary component of what we've seen. Instead of bonds suddenly representing a lower volatility asset that provided you with income and allowed you to rebalance because it had lower volatility and income associated with it in a down market, has suddenly turned into an environment in which we have expected bonds to rise in price in an adverse market event, right? That is really hard to do at these level of interest rates. And the extreme version of that can be found in places like Europe and Japan, where negative interest rates actually don't offer you any income, right? Like you're receiving no benefit other than the duration dynamic associated with it. Duration being the response to a change in interest rates. So you're now in a situation that you haven't really been in for the past 40 years, where you're actually paying for that protection. What's called the term premium in bonds, which logically we talked in another section about the idea of uncertainty, right? So traditionally it was thought that the term premium in bonds should be positive, meaning I'm going to have to receive excess compensation for locking my money up for a longer period of time.
You should earn more.
Exactly. So that's flipped. And now we actually have negative term premiums because people are paying extra for that potential for the bond to move a lot
or
in a
negative
risk-off
interest
event.
rates, period.
Negative interest rates are the extreme version of this. And again, it's not at all clear that the central banks really understand why the tools that they're using work. And you should be very concerned if the reaction function is, okay, press that button, ooh, that worked, press that button, ooh, that worked. If you don't actually understand the mechanics of why pressing that button is working, at some point they're going to press that button and it's going to be the wrong button to press.
For now, they're pressing the liquidity button, right?
Exactly.
And it just seems like a really, really fascinating time to be navigating. And for the most part, buying the dip and investing passively has been the dominant winning strategy. And so, we're here to help investors ultimately. You're here now, and you probably can actually help a greater number of people, right, in terms of a footprint, ETFs versus a hedge fund.
Within the area of my area of expertise on the derivative side, the ETF structure offers an improved solution for almost everyone, right? So one of the big drawbacks to derivative strategies is that your gains are short-term in nature by definition. It's relatively tax inefficient, which is one of the reasons why it has tended to have been dominated from the investor perspective in the non-taxable institutions, right? The endowments, et cetera. The ETF structure is receiving the same favorable tax treatment in derivatives as it did in equities. And that's a really, really important distinction, because what it means is even relative to the relative flexibility that you could have within a hedge fund to pursue extreme derivative strategies, you're going to receive much more favorable tax treatment in that ETF. And with taxes going higher, right, they certainly don't seem like they're going to go lower. In my view, this is going to become the preferred mechanism. And I'm incredibly excited, exactly as you say, to be able to spread the ability to help and participate, and hopefully it's clear that that's something I'm genuinely interested in and concerned with, to a much broader community. So it's just
exactly
an amazing opportunity.
We're going to work on democratizing access to these type of exposures and strategies, but it continues that trend. So an ETF, right, one shareholder has the same execution and cost and access as someone who puts in 1 million shares, right? You don't have sort of the multi-class structure that you see in even mutual funds. You have the same cost, the same transparency. And what's interesting, and again, an ex-PIMCO guy, by buying an ETF from a big shop or a professional desk, you're effectively accessing that execution ability. So if you're buying an ETF from PIMCO or BlackRock, you're basically buying bonds through that desk or through the largest market makers that provide those securities. And so it truly has democratized exposure, and it's obviously gone from betas, but what excites us is going beyond that and helping people navigate really the challenges and the choppy waters ahead and the opportunities, because it's not just about hedging, it's actually about outperforming and helping deliver against investment goals. So
you've been doing the ETF space for as long as I've been doing hedge funds,
Yep.
right? And Simplify is different in terms of what it's offering, right? It has a wide variety of products that it's brought in. Help me understand why. What's the benefit of offering a lot of different products as compared to, say, a single ETF?
So we talked about democratization, but a lot of it is, look, it's the preferred vehicle for a lot of investors. It makes life a lot easier. Whether you're managing on behalf of others or managing your own portfolio, it creates really interesting tools that you could piece together to build amazing portfolios, right? We've obviously seen attractive, cheap betas and exotic betas and novel solutions. We haven't seen the type of sophisticated strategies that you and your world, the hedge fund world, have offered previously, but we haven't seen that translate into the ETF vehicle. But if you think about where the vast majority of investors are accessing investor solutions, it is things like ETFs. And so I think there's an opportunity there where by simplifying, by creating a transparent offering to some of the best strategies and exposures, we could level the playing field, we could improve the financial outcome for a lot of people, but it also serves in the same way that a hedge fund does. It improves outcomes for professionals and advisors on par with institutions. Why should institutions get a leg up on interesting ways to protect a portfolio or earn interesting return streams? The rest of the world, technology and everything else that we interface with, you're seeing a decentralization and disruption. And so to me, the ETF vehicle is exactly that. It's a disruptor of entrenched offerings and expertise, and we're going to help distribute that expertise into the rest of the population. Yeah, the mom and pops, but first the advisors.
Yeah.
And it's a time when they need it really to sort of help improve portfolio construction, right? It's the most challenging time to invest. We just talked about inflation and sort of growth and all of these things and craziness. How do you address that if you only have the same sort of betas and vanilla exposures? Being able to create that into really interesting combinations, being able to hedge in ways that were not available before, I think it just improves the toolkit and improves the potential outcome.
So, I mean, the obvious answer to like why shouldn't, right,
Yep.
is because of the quantity of money, right? So,
Yep.
you know, if you're running $1 billion portfolio, you can access hedge fund talent and, you know, all sorts of stuff. But when you're an RIA, why not just run your own exposures in this, right? Why not buy your own options, your own derivatives, or do your 1% allocation to Bitcoin or anything else, right? Why don't advisors just do this themselves?
So there are a lot of reasons. Some do, just like some can buy their own muni bonds, but many choose to go sort of the more operationally convenient, the more professionally managed, a team managing an exposure and watching it every single day versus an advisor who has a practice to run, who's talking to clients all day long and happens to have a sliver of time to go check out the market. You're outsourcing the aspects that are outsourceable and frankly are beneficial to outsource, and then you're trying to keep sort of in-house the things that matter to your clients and your practice. And often that is more hand-holding, more education, more suitability type of conversations, and frankly just planning and understanding the client. And so by sort of diversifying sort of your workload into the parts that advisor could add the most value and outsourcing the parts that frankly are scale games or are things like futures, which are very big, right? Some of these contracts are 30, 40, 50,000 minimums, and how are you going to allocate that across hundreds of accounts. Or if you buy an SPX option, that's a $100,000 a contract. How are you going to manage that to fine tune a balance sheet? And so to be able to do the same thing that we're already comfortable as investors buying commingled funds that provide high yield muni bonds or other things, you could also outsource hedging and outsource alternative type structures, outsource the use of asymmetric payoffs to experts and to people who do it every single day and do it in a way that's meant to be scaled, tax efficient, transparent, and done in a way where we're going to provide education and tools that can be used to explain what these opportunities and what the benefits of these type of strategies are to the end client.
Well, you hit on I think a really important part there, which is this issue of what adds value to the client, right? And so I see this all the time. I certainly see it in my portfolios where things that catch all the attention, the sexy stuff, right? An XIV blow up, et cetera. The reality is that's 1% to 2% of your portfolio, right? And yet it can consume an insane amount of time and energy and distract you from the 98% of your portfolio that's carrying the load. To me, that is one of the most compelling components of the story, is that you can offer products that within the actual fund structure itself seem a modest allocation, but then it's appropriately weighted in the advisor portfolio and they don't have to worry about it in the same way.
Yeah, you don't have to do the paperwork, signing an overlay manager, or have the $1 million or $5 million minimum to get access to an alternative strategy. Keep it simple, keep it on an ETF vehicle, and put it inside of a portfolio, and really be able to fine tune for essentially almost any size client. And that's the magic of ETFs. It sort of takes these really big opportunities and shrinks them down to bite-sized, digestible pieces for people.
And they become building blocks in the portfolio, right? So
Exactly.
You hit on another point there that I've been incredibly impressed with in just the short time that I've been at Simplify. To the extent you talk about education, like what does that actually mean?
Education for us, from the Simplify perspective, is to really cut through the chase, right? Cut through the noise and deliver meaningful content, meaningful, impactful sort of perspectives. Things like, how do you protect against significant drawdowns? How do you earn income in a world where you have negative interest rates? Those are big problems, and we think we have really interesting, novel ways to solve them, but we're also going to educate. So you don't have to believe us, trust us. No, it's going to be, here's what we view as the opportunity, here's what we're doing about it, here's how we construct a portfolio, here's all the holdings in the portfolio, here's how it works, and then here are some really interesting tools in the Advisor Hub that allows you to get intuition around it so that an advisor understands, but more importantly, can explain it to his or her client and get buy-in and get the suitability issue addressed as well. And so it's a holistic challenge, provide really good and interesting solutions, but a product is not just a solution, it's the whole system, the ecosystem. When you buy an iPhone, it's not just a phone, you're buying access to the apps, access to Apple's infrastructure and the 5G signals that you use to get internet connections. It's tapping into that opportunity set, but providing the context for the use.
Advisors looking to do right by their clients have had to fight the impossible battle of protecting their clients' portfolios, only to risk underperforming and losing those clients in the process. But what if there was a better way? The playing field has been leveled, and new regulations mean, for the first time ever, option strategies no longer have to be managed in-house or by expensive and hard-to-access hedge funds. Advisors and individual investors of any size can now outsource these strategies to professionals like Simplify in low-fee and tax-efficient ETF vehicles. Through the power of convexity, Simplify is providing unique Beta 1 exposures to help advisors create portfolios that are protected when markets crash and juice returns when they rip higher.